Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, speaking to you from Queens in New York City. This is the 19th of March, 2019. Always like to remind you, I'm the author of a newsletter, Jay Taylor's Gold, Energy, and Tech Stocks. You can go to sign up for that at miningstocks.com. We like to tout chenpicks.com. That is, what is Chen buying, what is Chen selling? Go to chenpicks.com for that. And, of course, we also like Michael Oliver's letter, olivermsa.com. We'll be talking to Michael in just a moment. I do want to thank all of you for listening to this show, making it one of the more popular shows in the Voice of America Business Channel. And always will encourage you to go to questionsfortaylor@gmail.com. Questions and number 4, taylor@gmail.com. Send along your comments, any comments you might have about our show. Always welcome. I do need to thank our sponsors for making this show economically viable. Today's sponsors: Gold Mining Inc., Great Bear Resources, Klondike Gold, Novo Resources, Triumph Gold, Uranium Energy, and Merrimont Resources. Well, we got today's show. I'm going to be talking to Dr. Benjamin Weicker about his book, Worshipping the State: How Liberalism Became Our State Religion. I think a lot of the things that are going on economically, spiritually, socially, almost every direction you look comes from a change in the philosophy of government that is diametrically opposed to the founders of our country. And we'll be talking to Dr. Weicker about some of the historical figures, intellectuals that have fed into this, what I think is a very destructive theme that's taking place in America now. We're also going to be talking to Bob Moriarty in just a few minutes about a very interesting new company that he is following. Actually, he's been following it for 15 years, but it's a company that he really likes a lot, and it is one that I'm starting to take a look at myself, and Bob will be with me after our first commercial break. But right now, I'm happy to tell you that Michael Oliver is with me once again. Thanks for joining me, Michael.
Good to be back, Jay.
Always good to have you. My most frequent guest. Nobody comes close to the number of appearances you've made on this show, and that's out of popular request. And certainly my request, because I find you so helpful to me in my investment decisions as time goes on. In your weekend report, you talked quite a lot about the dollar. It occupied more of your thinking and space than usual in your letter. And you know, very often you do make comments about the dollar, but this time it seemed to be more important, and you gave it more importance anyway than most of the times. And you headed up the article, the weekend report, with a title, Major Forex, a category about to make noise. So tell us why you're seeing the dollar now at this point in time as a very critical market to keep our eyes on.
Yeah, it's both critical and uncritical, but on the critical aspect, it's been dormant for, let's put it this way, the dollar rally that followed a major drop, by the way, dropped from 104 down to $88 index we're talking about. It then rallied back up into the high 90s. The dollar index reached last August up to almost 97, in fact, one decimal short of touching 97. If you draw a line horizontal from August high of last year through the present, it oscillated a few percentage points either side of 97, meaning nothing was happening. And that's also reflective of the euro. Euro is 57% of the dollar index. So the two biggest currencies out there were dead. Literally, I mean, you could hardly trade them. Okay? Now, during that time, August of last year, where the dollar was at a high, a secondary high, gold was just above 1160. Now, if you took the normal orthodox logic of, well, the dollar's got to rise or fall to make gold move. So if you want gold to go up, dollar's got to go down. Well, the dollar last Friday closed at 96.50. So it's barely below the high it was trading in August. If you'd have followed that logic, you would assume that gold would have gone sideways as well. Instead, gold went from a low just above 1160 to a high several weeks ago at 1344. So something didn't work in the orthodoxy there. Okay, now take it even further back. By the way, we do think the dollar is about to roll over again from this rally, and we think it's close to the numbers that if you find it trading around 96 level when the second quarter opens up, which is less than 2 weeks away, that it will head south again, probably hard. But that's not a primary motivator for gold, obviously, because gold rallied 16%, basically straight up since the August low, without any assistance whatsoever from a weak dollar. Okay. Now you can even take this logic further back to disprove the orthodoxy. Go back to February of 2016, so three years and a month ago. Okay, the dollar index in that month was trading at 97. So you could draw a line from February 2016 across the page, and you'll find ups and downs well above and below that level. But it's still beehived around that level now. It was 3 years and a month ago. Well, 3 years and a month ago was when MSA, Momentum Structural Analysis, signaled a major annual momentum buy signal on gold.
Right.
And it came up from its bare lows. Bare lows were below 1045, and it came up to 1140, and we said, that's it, it's over, bull market. So now, circle that, 1140, we're now trading at 1310, okay?
Yep.
And dollar index is where it was at that time. So again, even on a longer-term vista, using the dollar as your metric to judge gold, up or down, is a waste of time. Okay?
Yeah.
Now, admittedly, I think it will help gold if the dollar does weaken, but it's a secondary event. And I think that secondary event's about to occur. And that will, of course, wake up the orthodox folks who will say, well, the dollar's getting weak, so we got to buy gold. They're a little late, but that's fine. We welcome them in.
Yeah.
Anyway.
Well, in the meantime, of course, the equity markets remain pretty strong. They at least the price does. I have to think there's some smart money coming out of some of those other markets moving into gold. I mean, it's not as if there's a panic. It's almost as if gold is asleep. It's rising a little bit, but not too many people are paying much attention to it. And you, I guess, still believe that that's likely to happen until we see a price chart break out. At what are you figuring that number is now, Michael?
Well, there's a trend line on the price chart. It's more or less flat. It goes back 5 years. Every rally high since late 2014 is up in the mid to upper 1300s. It's a gradually declining line. And I'd say right now, if you take out the recent rally high, which is 1344 several weeks ago, you take that out and the price guys are going to wake up and say, my gosh, this is a major bottom completed. And they'll join in. And I also suspect that at that time, that's when the dollar will be rolling over to the downside. So those two will match up at that point in time. But we're already bullish from much lower levels, and it's great to have other people buy after you've already bought. So
that's for sure.
I do think the structure on the price chart is very clear, and it will excite a lot of investors and analysts going back up through that mid-1300 level. And I suspect strongly that that's about to occur in the next few weeks, probably.
Well, certainly one of the reasons that I like your work so much is that your momentum work usually does have people getting in before the masses do and getting out before there is a panic exit as well. So that's what we like, Michael, and that's why you're here with us every week. I ask, this equity market, though, it just does seem to me that equities are defying the laws of gravity, huh?
Well, I think you need to split the worldwide stock market into two, the emerging and the developed, and many people do that. But the emerging markets, in fact, last week, let's say, for example, the S&P was up 2.88%, okay, and that'd be the headline. Well, emerging market ETF was up 3.5%. Nobody's focused on that. Shanghai has been up far stronger, Shanghai Composite Index. We're positive with some conditionals on the emerging markets and Chinese market in relation to the developed markets. First off, if you just stand back and look at Shanghai, for example, it's collapsed since the 2015 high at 5,200 down into the 2,000s. It's right now about 3,000, okay? It's had a big drop. So a lot of people who don't like government stimulus, and the Chinese are back to stimulating again, they think that's intellectually a deficient way to move a stock market. And I agree with that. But with a market that's been cut in half and therefore is deflated to some extent, those type of stimuli will work. They don't work, I think, after a 10-year bull market that's very aged, showing technical breakage, so that if the central banks of the developed markets try a stimulus in the near future, for example, if we get another stock market wobble, I don't think it's going to work. I think instead that river flow of money is going into value plays, namely commodities, further into gold, and into emerging markets. And emerging markets, after all, reflect, to some extent, commodity action, and therefore that's why they're, to some extent, deflated, like commodities are. So I think that river flow is already underway. Gold is exhibiting it strongly, because it's not laying on its back. It's near 4 and 5 year highs. And I think that it's subtle. The investor preference shift is subtle but determined. And we see it most in gold right now, but I think you're about to see it in a lot of the food commodities.
Yeah, you're remaining very bullish on the food commodities.
I remain bullish on that value category. I think it's like got a zip risk on the downside if you can own the cash markets. And when they come alive, I think they'll come alive in a robust way. By the way, this is not true with crude oil. It's one market I think I'd stick away from here. But
right. And so let me just ask you, with 30 seconds or so left here, Michael, you did comment about a correlation between equities and crude, right?
Oh, yes.
The
in
S&P.
fact, if you go back the last 3 or 4 years and overlay a crude oil futures chart on top of an S&P chart, you'll be stunned with the similarity. The crude oil is having a savage rally right now, percent-wise. It's still way below the highs it made last September, October, when the S&P was peaking. It collapsed right along with the S&P, and then it rebounded with it. But I don't trust crude oil at this point to sustain or be worth the investment. But I do think the food commodities are a place to be.
All right.
They're very much lagged, and I think gold will continue to lead the commodity indexes.
All right. Excellent. Well, I thank you once again, Michael, for being with us.
Thanks, Jay.
Your insights are always of great value to us. And again, folks, it's olivermsa.com, olivermsa.com, if you want to really take advantage of what Michael has to offer. You know, you get what you pay for. You're listening to his show. You're listening to this show. He's kind enough to share some of his ideas with you. But if you really want to take advantage of his expertise, do what I do. Get his daily report.